In this video, I will explore the financial implication of choosing between a fixed and a variable interest rate when financing a vehicle. Interest rates are often misunderstood, particularly when applied to significant financial commitments such as car or home loans. This video aims to simplify the concept and provide clarity, enabling the viewers to make more informed decisions. Please note that the content shared is for educational purposes only and does not constitute financial advice. Welcome to this personal finance series. My name is David Masham. I'm an industrial engineer by profession with a passion for simplifying complex topics into practical, easy to understand concepts. Through this series, I aim to address common challenges in personal finance, an area that remains largely absent from formal education. By engaging with this content, you are taking a meaningful step towards financial literacy. Before I start discussing the two examples that you see on the screen, let me start by explaining what interest rate is. An interest rate represents a cost of borrowing money or the return earned on savings. It is often expressed as a percentage of principal amount. Talking about interest rate, we cannot talk about interest rate without touching prime lending rate. A prime lending rate is set by South African Reserve Bank and serves as a benchmark used by the banks when they lend money to their clients. It is often given to their creditworthy customers, meaning these are the customers with a great or good credit score. The Monetary Policy Committee (MPC) meets 6 times a year to discuss and review these rates. So, meaning that this rate cannot remain the same forever. It changes based on economic conditions of the country and the world at large. So now let's look into this example that I've got today. I'm the person that believes in making practical example in order to understand complex problems. So let's look at this one here. So this is it. I hope that it will address the issue of fixed and variable interest rate, which one you should choose. Remember, at some point when you purchase your car using finance, you're gonna be presented with the opportunity to choose between fixed or variable interest rate. Therefore, in this situation, you need to know which one you are going to choose. And I hope in this example will help to clarify that. So now this example look back at the history. So now we've got two candidates. We've got candidate A this side, candidate B this side. Candidate A is taking a car loan on the fixed interest rate. Candidate B takes the loan using a variable interest rate. But by looking at the way, I believe that they, in a way, try and explain themselves. A fixed interest rate remains the same throughout the loan period, whilst the variable interest rate changes based on the prime lending rate, which I just explained now. So now let's look back at these two candidates. Say in January 2024, candidate A, they are purchasing the same vehicle, same amount, but the interest rates are different. The prime lending rate at the time in January 2024 at the time was at 11.75. Let's say now a bank offered candidate A slightly above the lending rate at the time, which is 12.5. And let's say now the other bank or the same bank offered candidate B, also slightly above uh, prime lending rate 12.5, which these normally happens. Now, you would notice that the fixed interest rate, usually the interest rate that they will offer you on the fixed interest rate, will be slightly higher compared to the variable interest rate. So now these are the rates that have been offered. The loan period are the same. The number of payments per year that needs to be made, they're the same. They each pay their car monthly, and the start dates are the same. So now we're going to be looking at this example, just covering the past 2 years from 2024 January to 2025 December. So you notice on this table, this side here, I got the fixed interest rate, and the rate remains the same throughout for this candidate, going down up until year, and just continues up until the rest of the loan period. And this side, the variable interest rate of candidate B keeps on changing as the prime lending rate changes. So now concept number two, the rate, the interest rate on the variable changes with the prime lending rate. We need to grasp that. So coming back to this side to candidate A, let's look at the repayment now. The repayments of the candidate A is 5,943, and those payments, they remain the same throughout. Hence, fixed interest rate. The repayment remain fixed. So this now, it is an advantage for fixed interest rate, which is for planning purposes. You know that your repayments are going to be the same throughout the loan period, and it allows you to plan much better. Whereas coming to this side now, the variable interest rate, you can see the repayments here, 5,865 francs. It remains the same here, remains the same here, remains the same here, and then changes here as the interest rate changes. You see here, it went down, and then here from 5,880 to 5,796, it went down. The reason it's going down is because of the interest rate was going down. So if now the interest rate was going, or the prime lending rate was going up, it means that your repayment may be going up as well. So that is one of the downfall, or it can be an advantage if the prime lending rate are going down. But if the prime lending rate goes up, it means your monthly repayment, they keep on going up. And you can see here on this side, I try to make the difference. I'm trying to compare the two candidates now. Who has been better off in this scenario for the past 2 years? The reason I'm using the history is that I cannot tell now what the interest rate will be in the next 5 years. But history can only help us to learn from what has happened and the decision that has been made at a particular time. So you see here already the difference between the two. The candidate B with the variable interest rate is paying during this period was paying 78 rands less than candidate A. And then you see as it keeps on changing here, the gap keeps on going up because of the interest rate was going up. So now let's look here. On the last year, candidate A was still, this is not the final year, but the year that we choose to just to do the analysis. He's still paying that amount, but candidate B is paying now 5,648, which is now way less than candidate B. So let's see now at the bottom with the summaries. You see, in terms of the total repayment that are made by candidate A, this was the amount. And candidate B, if you this is the total repayments that they made during this period, this is the amount. So you can see here, this candidate B is less than, repayments are less than candidate A by roughly 4,000. Let's round it up. And then when it comes to the principal that they contributed to, candidate B contributed 70, around about 78,000, whereas A contributed 76,000, with a difference of roughly 2,000. And then now coming to interest rate, the interest rate, candidate B, interest rate contributed 60,000, candidate A contributed 66,000. So there's more money for candidate B in terms of his repayment that went to interest rate compared to candidate A. You see, almost 6,000 difference that has just been taken by the bank and didn't contribute to reducing the actual balance of the vehicle. So you can see between the two candidates who has been better off during this period. Candidate B has been better off in terms of the repayments that they made, contributions to the principal, contribution to the interest rate. And now let's then and the ending balance. Let's look at the ending balance for candidate B, 221,000, whereas this side is 223,000, slightly 2,000 less than candidate A. So what can we learn from this? The scenario might not always look like this. Scenarios might change. But in this case, you can see, let's quickly go down here. You can see I've just made a graph for the two or three rates. The prime lending rate, this is the graph for the prime lending rate. You can see the trend was generally going down, which means that the guy that took a fixed interest rate for this period did not score. He did not take the advantage of the trend that was going down. But the guy with the variable interest rate was able to score due to this trend, making his repayment less and less month to month as time as with the changes in prime lending rate. You can see here the guy with the fixed interest rate, his interest remain the same. So what's the key takeaway from this exercise? Fixed interest rate allows you to plan better as your monthly repayment are fixed, they remain the same throughout the loan period. But the disadvantage may be that if for the duration of the period that you're going to be paying your loan, the interest rate goes down, then you are not going to score. But if the interest rate goes up during that period, the trend goes up, then you are going to score eventually. Generally, the other disadvantage, generally the interest rate on the fixed interest, it is slightly higher. I think this is for the bank to protect themselves if anything happens with the interest rate. If they shoot up, they know that they can still score from the interest that they have charged you. Whereas the variable interest rate side, this is now for the person that is willing to take risk. They are willing to take risk with the interest rate fluctuations. If they happen to go down, you score. If the interest rate or the prime lending rate goes up, then unfortunately you're gonna have to carry the cost. If it was only possible to predict what interest rate or which direction the interest rates are gonna go in the next 5 years of you taking your loan, then it was gonna be an easy exercise. It was gonna be a straightforward answer. But in this case, it is up to you. You choose a peace of mind, fixed interest rate, or you're willing to take the risk with the prime lending rate that keeps on changing. So I hope that I've covered to the maximum, and I hope these will help you make better decision when you take the loan. If you haven't, please subscribe, comment, like, share with the friends and family, colleagues, and thank you so much. Until the next one. Thank you.